Hello, Woden's Day economic people. Gallup, United States. Have a look at that chart. It says unemployment is going from 8.8, 9.3, 9.6, 10 to 10.3. There is a discrepancy here between this and the BLS data. Which one is BLS? This is the price of gas in the United States. You can see that big spike in the middle is the 2008 spike, and you can see it just shoving up its way up the right hand side there. In the United States the price goes up more pro rata to the barrel price, as opposed to Europe where so much tax is involved in the price. So it rises very quickly, and it's up through 350 now. This is an interesting chart. This is about Ben Bernanke and the way his mind works and what he will be thinking of this. Along the bottom of this graph is the ISM prices paid. Now they've cut it off at 80. Anything above 80 are excessively high. They're high prices being paid. In other words, threat of inflation, because the manufacturers, the prices they're paying, the inputs are high. So that's a threat of inflation. But it's against the other axis, which is capacity utilization, how much the factories are really pumping. Now, Ben Bernanke will see that the prices being paid are high along the bottom axis, but along the vertical axis, it's the lowest of the entire scatter chart. Normally you'd expect higher prices to be paid when CAPU, capacity utilization, is around 85 plus. That's where the main scatter is there. But you can see the lighter blue blob is where it is now. It's an abnormality. But that is, for Linda, that could be considered a buffer stock in Bernanke's mind. He won't be worried about inflation until that light blue blob floats upwards into the capacity utilization around 85. Do they call it percent? 85 anyway for CAPU. Yeah, it is percentage of total theoretical capacity. It's capable of getting up to 95. So down at 75, Bernanke will not be the slightest bit bothered about any seeming inflation that's out there. Next, Fortune magazine or newspaper or whatever this is, and it was very annoying, but I'll go through a bit of it and we'll see if you find it annoying too. Don't blame Mideast turmoil for oil woes. And it's this chap. What was his name? Michael Elliott. Oh, isn't he the chap that does The Guardian in UK? Don't know. Time for a reality check, which is good. I mean, it's saying, come on, let's have a good think here. Nobody loves short-term volatility in the markets except traders. But the idea that revolution in the Middle East is going to translate through expensive oil into sustained global downturn seems way off. And he goes on to explain why. First, for Libya, it only accounts for less than 2% of global oil production. And that's a bit annoying because he said revolution in the Middle East and then only picked out the singular one, which is Libya, which is only 2%. So that's a bit annoying, but it's right. Second, whoever runs that country eventually will quickly figure out that oil is of no value if it's left in the ground. Which we know what he means, but that's annoying as well, because obviously the oil in the ground is worth something. It is of value, but we know what he means, and he's right. Third, Saudi Arabia can always increase supply. Now that's annoying because he hasn't a clue. But yes, theoretically he's right. Saudi Arabia theoretically can increase supply if they say they can. We don't know any better either. And once prices spiked, started talking about how it might do so. That Saudi Arabia has started talking about how it might do so. Which is annoying because they haven't said, right, your oil's on the way. Your extra oil. So, fourth, The old assumptions about the rise in the cost of oil leading to a concomitant reduction in output don't hold as they once did. The run-up in oil prices to 2008 coincided with a sustained period of global growth. Now, I'd like to say he's wrong there, but he's not. He's right. Up to the recession bust, there was a global boom, and oil was rising all the way through it. So he's right. And it's annoying. On the demand, later in the article, on the demand side, then, you would expect that the long term, say over 20 years, and I don't like them, I find it annoying to talk about the price of over 20 years, or anything over 20 years, because nobody knows. The price of oil is indeed going to go up, but he's probably right there. What about supply? Markets being wonderful things, high prices for any commodity stimulate investment in producing it. But at some level, whether you believe oil production has peaked or not, the global supply of oil is finite. Now, it's rather annoying that he kind of lumps oil in with other produced goods, but he's then kind of lets himself off by noting that the global supply of oil is finite. A lot of new oil discoveries are either in place, annoying, are in places that are technologically challenging or expensive to exploit. Not annoying. Good comment. Sorry. Good. Well done. Like Brazil's continental shelf, or where environmental concerns add to the time and cost of bringing projects on stream, such as the Arctic or Canadian. Oil tar. So oil is indeed going to be more expensive, and one day that will make renewable energy options like wind and solar truly cost effective. And again, it's annoying. It's an annoying comment. So oil is indeed going to be more expensive, yes, and one day that will make renewable energy options like wind and solar truly cost effective. Yes, they might be even cheaper to get some amounts of some energy to somewhere cheaper than you can from oil. But that's cost effective, but that price might be absolutely right up there, humongous, enormous. So it's an annoying little article, but he's generally right, I think, all up and down the board. So it's a good article. Next, Saudi regime arrests 26 Shiites as banned protests grow in the east. The Saudi Arabian government has arrested at least 26 protesters in the eastern oasis of Al-Qatif over the past few days, all of them apparently members of the nation's Shiite minority. We might hear a lot of this Shia thing going on, unfortunately. Down in red there, the Saudi Council of Senior Clerics, the religious underpinnings of the regime, also endorsed threats by Interior Ministry officials against the protests on the grounds that protesting against one's regime is un-Islamic, with the clerical statement reiterating the regime's claim to divine right to rule. The religious people say that the king has the divine right to rule. Yeah, sure, George. China 5-year plan for a consumer nation. The Chinese government commitment to make China more of a consumer nation got a little flesh on it this week at the annual session of the National People's Congress. They've pushed out their new 5-year plan. As Tilt, that's my special bit of Financial Times that I look at, Tilt reported earlier much of the content of the 12th 5-year plan was already known, but analysts were pleased by the government's tone. We are impressed with the seriousness with which the government has addressed the need to rebalance the economy by promoting consumption, services and strategic industries, said analyst at Nomura. While Chinese consumers already buoy the market for luxury goods, at the top end of course, the plan aims for a more modest society of shoppers where rural consumers spend on apparel and appliances, and workers regularly pick up packaged food on the way home. Isn't that terrible? that sort of project would normally be the biggest project that the world of economics would be looking at, whether China can move to a more consumer economy, which would be a huge walk from here to there, very, very difficult. And it's not just difficult now, a storm is raging, there's a civil war broken out, and there's an earthquake. That's metaphorical. How difficult that walk is for them is going to be to a consumer society. Very difficult. Running out of time. Global Business, New York Times. Fears of wheat crisis in China recedes as drought eases. Apparently there's been snow and rain in the right places, and they might save an awful lot of their wheat. So a lot of people aren't going to starve, which has got to be good. New York Times again. European pipeline project faces formidable obstacles. This is Nabucco, and it's the EU, the European people priced it at one price. The oil companies have come in and said, don't be bloody stupid, it'll cost us much more than that. And they say, well, we can't afford it then. Even if the pipeline is completed, there is issues of finding natural gas to fill it. The consortium has been banking on Azerbaijan, which has vast reserves of gas, but those fields have not yet been developed. Not perfect. But this was to try and get a second pipeline into Europe, because the one that they've got at the moment kind of relies on Russia, which is a dodgy thing to be doing. These three charts from the Financial Times Alphaville are well worth a good look at, so it could be a pause and look. All of the euro area's excessive leverage is in the periphery. You can see up the ringed ones, Ireland, Spain and Portugal, those are private leverage of households, percentage of GDP, and they're well up there. So we'll get that from the next chart, but you can pause and have a look at that. It's interesting to see who's high. Denmark's an outlier. Very strange thing, Denmark. Next thing is that most excess leverage is in floating rate debt. You can see on the right, Canada, US, France and Germany don't have floating rate mortgages. They're fixed rate mortgages. But you could say the rest of the world do have floating rate mortgages. Belgium, Sweden, Japan, UK, Italy, Denmark, Ireland, Spain, Portugal have floating rate. So obviously interest rates go up. They're already in trouble, and they would be well and truly. The last chart here is the Taylor rule. You know, the academic Taylor, who said the Fed have kind of been using it on and off. I think it's about 20 years old, and it's based only on a couple of metrics that you can easily just put into a computer, and the Taylor rule will tell you what your interest rate should be. And just to note that if you look for the housing boom, the Taylor rule said the Fed was being very naughty, keeping the interest rate too low. It's generally accepted to be not a bad way of giving a rule of thumb where the interest rate should be for a country if you put these metrics in. Here we have Germany, that top line, and that is now where the interest rate should be for Germany. 4.5% plus 4.5%, but the grey line at the bottom is the average for Spain, Ireland, Greece and Portugal, and it is minus 4.6%. There's a 9% difference between where the Taylor rule says the peripheral pigs should be and Germany should be, and the dotted line is where it actually is, in the middle. In other words, it's not right for Germany, where there should be now some sort of a boom, and it's certainly not right for the pigs because it's too high. Euro, not a perfect scheme. Leave it there. Thanks. Bye.